Back. Thanks for coming back. My name's Alexa. I'm the manager of operations here at BPM RIA. I'm here for all your general inquiries, questions. I'll be putting some helpful information in the chat for you guys. And then whatever questions you have for John today, you'll be putting those directly in the Q&A, and we'll go ahead and answer those live for you all. So today we're going to discuss how we can accelerate our retirement goals by buying and managing real estate in a self-directed IRA, which is something that Anish, our CEO and lead mentor, has been doing for years now and completely changed the game. So you guys are definitely going to want to pay attention today and take advantage of the time we have with John and put those questions directly in the Q&A section, and he's going to be answering those for you guys. So just a couple quick things coming up. We have all these great events coming up, guys. RIAFAX, they have a new technology, March 22nd, you're going to want to be there. Smart home loans, we haven't had them for a bit, so you're going to want to come to these free webinars. All of these are really good this month and next month. Big star highlight, our next in-person networking meeting is April 6th. This will be at the Signature Grand. We needed more space. The meeting in January was absolutely insane. We had so many people, it was phenomenal. We had corporate vendors there for the networking portion that takes place from 5:30 to 7, and then we'll have the educational portion from 7 to 8:30. So if you have any questions about this, go ahead and give me a call, but you can find all of these upcoming events on our website, and I'll be putting all these links in the chat for you guys in just a second. So if you want to stay up to date on our events, you're just going to want to text this BPM REIA to 954-800-6961. We're not going to spam you. This is just to give you alerts on when our events are coming up. I'll be putting that number in the chat for you guys if I'm running a little bit quick too, so don't worry. Our next quick start, we're actually switching this date. We're so sorry, this is actually Mother's Day weekend, so we're going to postpone this to the 21st and 22nd. I'm going to send you guys an email and text blast sometime this week just to give you guys a heads up, but we are so sorry. We are moving so fast that we completely skipped that. So Mother's Day weekend, cancel that 7th and 8th. We're going to switch that to the 21st and 22nd. And if you bought your ticket already, I'll be in touch with you today. You already know that a membership with us can get you a lot of benefits. We are partnered with the National RIA and have their wonderful benefit package that includes discounts at Home Depot, Office Max. We have amazing deals with equity trusts, amazing benefits of being having a relationship with them. You get into our in-person meetings for free if you are a member. You get discounts and early reservations for a lot of different things. If you are a business owner and you want to discuss corporate memberships, go ahead and reach out to me directly. I'll be putting my contact information in the chat in just a moment. Of course, we do have our one-on-one coaching programs. You may or may not know about this, but we do teach you one-on-one. We put up 100% of the money for our students' deals and then split the profit 50-50. This may or may not be a fit for you. Please reach out to me if you have more questions. My number is right here. And you can also book a discovery call with me on our website if you'd like to get more information. You can just go to bpmria.com. You'll see book a discovery call, be just a quick call just to get more information. Or if you just want to know how you can get more connected in this network, go ahead and book that. And always want to thank our sponsors. Being a partner with the National RIA is something we don't take lightly, and we are just very grateful to get all of the great things that we do get from being with the National RIA. So without further ado, I want you guys to get your notebooks out, put those questions in the Q&A section, just soak up what John's about to, some of this might be fresh information for you guys, and that's okay, because it feels like almost everybody that comes on here is teaching me something I just opening my eyes to another world. So pay attention. Here's John. He will go ahead and introduce himself because I don't want to take any more of his time. So thank you, John, for being here.
Awesome. Hey, thank you so much, Alexa. Really appreciate the introduction. And thank you, everyone, for attending today's program on self-directed IRAs to invest in real estate. And as we go throughout the program, we're going to go beyond just how to invest in real estate with a self-directed IRA. What I really want to share with you today is how you can get to your retirement goals and your financial goals in the shortest period of time possible. I also want to thank Anish and Anish's team. I've known Anish for probably close to a decade now, and I speak at real estate investor associations all throughout the country. And I would be remiss to not take a moment to comment on the quality of education that BPM RIA provides, the webinars, in addition to the monthly meetings, all of the other content opportunities that folks can take advantage of. And I will say, in comparison to other real estate investor associations, that the BPM RIA is really on the cutting edge in terms of the education, the mentorship, and all the programs that they offer. So for those of you that might be a little bit newer to BPM RIA, know as an outsider, somebody that's from Cleveland, Ohio, looking in, just certainly wanted to take a moment to mention the quality that I see in that organization. So thank you, Anish and team, for that and having me today. So topic of conversation, I'm going to jump right into it. We're going to be pretty fast. We're going to give you a lot of content in this short period of time, and certainly give you an opportunity after today's program. If you want to follow up with myself or my team or take advantage of some of other outlets, you'll be able to do that. Just on a high level, self-directed IRA investing in real estate. What you're going to learn is there are some very significant, very meaningful tax advantages that you're going to be able to take advantage of with respect to a self-directed IRA, solo 401k, or other self-directed retirement account. And you're going to learn that you can invest in real estate, you can invest in private lending, you can invest in wholesaling. There's a lot of different ways in which you can grow a retirement plan to invest in real estate. The key here is what we're sharing with folks is how to get to the retirement goals and their financial goals in the shortest period of time possible. And if you can see my screen here, you'll notice that I'll be toggling between my slides and also the whiteboard that's behind me. So if I say, come with me to the whiteboard, you'll know that I'll be diagramming something on the whiteboard. Otherwise, you might see some slides on your screen. So just make sure you pay special close attention to your screen as we navigate throughout. And as Alexa mentioned, feel free to ask your questions in the Q&A box. I will pause throughout the program and answer as many questions as I can. Any questions that require maybe a more detailed or customized response, then I will follow up with you one-on-one after today's program. All right, so with that housekeeping item out of the way, what you see here is a financial equation leading to an abundant retirement. And abundant retirement means different things to different folks. For some investors that I work with one-on-one, an abundant retirement to them means just being able to preserve their capital. Let's face it, with inflation at 8%, or could even be more than that at this point in time. But last I checked, January of 2022 here, it was 7.5%. And now it's closer to 8%, if not more than 8% reported. And so a lot of investors that I'm working with right now are very concerned with respect to inflation and what's going to happen or continue to happen with inflation. And so ultimately, for those of you that aren't familiar, what this means is if your return on investment is not greater than 8% right now, then you're losing money. And so a lot of investors that I work with, they come to equity trusts and they come to a self-directed IRA as a lifeboat for them to migrate their retirement, their hard-earned retirement dollars, away from the traditional financial markets, away from stocks, bonds, and mutual funds, and into income-producing real estate, something that they feel they have a lot more control over, they have a lot more experience with. And even for those that maybe don't have a whole lot of experience, but you're gaining experience, you might feel a lot more comfortable investing in real estate than the traditional stock market. Now, I'm not here to prognosticate what's going to happen in the stock market. There are people out there that I'm hearing are saying we're going to enter a recession and a bear market. Some people are saying after the Fed Reserve makes their announcement this week, we're going to see a market rally. Then we're going to see a swing in the other direction. Then we're going to see a bear market. I can't tell you what's going to happen in the traditional financial markets. Now, I can certainly say that there are a lot of investors that have, as of recent, have been reaching out to me with a great deal of concern with respect to what's happening in the traditional financial markets. And so they are now pivoting to migrate their retirement dollars, their IRAs, their 401ks, their 403bs, their 457s, their thrift savings plans into a self-directed IRA in order to invest in real estate. And I'm going to share with you how to do this. So not just the what can you do, but the real how-to application of investing in real estate with a self-directed IRA. Couple notes on myself. I'm John Bowens again. I am the head of education here at Equity Trust. I'm also a real estate investor. So I'm wearing both hats here as an investor as well as a representative of Equity Trust. I've been in real estate for close to 20 years. I've been in self-directed IRAs for about 15 years, and I've trained over 60,000 investors across the country. I don't spend a lot of time when I jump on programs like this talking about myself or my background or organization. Just a couple facts about our organization. We do business in all 50 states. We have over 100,000 clients, and we custody over $33 billion in assets. And many of those assets are real estate related assets. So that's what we're going to focus on in today's program. So with that quick bio and Equity Trust introduction aside, I'm just going to jump right into some of the learning objectives. And the best way that I have learned over the last 15 years to teach this business is by using real client investment examples. And so here's Kevin and Cynthia. We're going to start with them. And Kevin and Cynthia are investors that I met back in 2010. And back in 2010, there were a lot of investors that were jumping into real estate, using their IRAs and 401ks to buy more properties. What happened in 2007 and 2008? Well, we had the Great Recession. And so Kevin and Cynthia, their words, not mine, their retirement accounts, their 401ks were decimated in the traditional markets. Now, fortunately, they were able to recover from those losses. And in 2010, it made a lot of sense for them to move over their 401ks into self-directed IRAs. And then from there, they began buying and selling real estate. They are not active fix and flip type investors. They're more buy and hold for long-term cash flow, but they did find a strategy with respect to selling some of the properties in their IRAs to recapitalize and then be able to deploy that capital for more investments. So they started with about $100,000 in 2010. And over the course of 11 to 12 years now, they've grown that $100,000 to over $1 million in properties and $130,000 in cash flow coming in on an annual basis. And that's tax-free cash flow. So Kevin and Cynthia started in 2010. Fast forward to today, they have 14 cash flowing properties. So let me stop sharing my screen for just a moment. And what I'm going to do is jump to the whiteboard here, because what we're going to do is actually detail out how Kevin and Cynthia did this. So their strategy is buy and hold investments. And when I say buy and hold, it's not just traditional rentals. They also buy, renovate, and sell on owner financing. So their IRA carries a note and mortgage. They also buy, renovate, and sell on a lease option to purchase. And then they do have some traditional buy and hold long-term rentals. The buy, fix, and sell on owner financing, they call it their path to home ownership. That strategy in the early days allowed them to quickly turn their cash over, create profit, recognize profit, be able to take that capital and redeploy it into more investments. In 2010, they only had enough in between their two IRAs to buy one property. Then in year 2, they were able to buy a second. Year 3, they were able to get to number 3. And then number 4, they've done over 20 houses. They still to this day have 14 properties. So for some investors out there, if you're starting with a smaller amount of money in an IRA, you may have to look for investments or strategies that make sense for a smaller dollar retirement plan. My next example I'm going to share with you is a real estate joint venture where you're going to learn about an investor by the name of Scott, who made an investment with as little as $24,000, partnering with another investor in a real estate joint venture, and grew his Roth IRA from about $24,000 to over $66,000 tax-free. So I say this at the very beginning because I don't want folks to tune out of the conversation because maybe they don't have hundreds of thousands of dollars in a retirement plan to get started with. Maybe you only have a small amount of money to get started with in a retirement plan. That's okay. We can share with you how you can use your self-directed IRA, self-directed Roth IRA, solo 401k to still participate in real estate transactions that can make a meaningful difference to your long-term financial strategy. Again, like I mentioned at the very beginning, what we're talking about is getting to your retirement goals and your financial goals in the shortest period of time possible. For Kevin and Cynthia, they wanted to get to their retirement goals in the shortest period of time possible. And they understood that if they used their self-directed Roth IRAs, that they would eliminate the variable of taxation. So if we go back to this financial equation here, everything that we're talking about is eliminating this variable of taxation. See, if we eliminate the variable of taxation, we can effectively increase our yield. If we can increase our annual yield, we can get to our retirement goals in a shorter period of time. That's what I call compounding interest in the absence of taxation. So for those of you that are taking really good notes, that would be something for you to write down: compounding interest in the absence of taxation. Or to make it shorter for you, because that's a little bit of a mouthful, compounding interest with no taxes. And compounding interest with increasing your yield, again, can get to our retirement goals and our financial goals in a shorter period of time. So that's that. When I'm talking about the financial equation and eliminating taxes and compounding interest in the absence of taxation, I'm actually going to share with you an example in a few moments so you can wrap your head around this a little bit better. But back to Kevin and Cynthia. So Kevin and Cynthia started with $100,000, and these were in 401ks. So they left their jobs. One of the things you're going to learn is, in order to unlock your 401k, if you're currently working with the company that offers the 401k, to unlock that 401k, you're going to either have to leave the company, attain the age of 59 and a half, which is the qualified retirement age, or in some instances, you might have a 401k that offers a provision that would allow you to roll over the money while you're still working. This is called an in-service rollover. So if you have a 401k with a current company you're working for, or maybe it's a 403b or a 457, you're going to want to call and find out if you can do an in-service rollover. If you've left the company, you're going to have no issues. You can simply roll it over into a self-directed IRA. If you have an existing IRA, Roth IRA, SEP IRA, simple IRA, that's very easy. You're going to learn that we can simply help you transfer that money from the existing IRA into the self-directed IRA. And by the way, there's no taxes or penalties to move money from point A to point B. You're simply just moving the cash from the existing retirement plan into the self-directed IRA. So Kevin and Cynthia started with $100,000. They had a 401k in each one of their names. So two separate accounts. The first thing that they did is they rolled the money over into what's called a traditional IRA. Traditional IRA. A traditional IRA is what's referred to as tax deferred, tax deductible. So what that means is when you put money in, you get a tax deduction. And this is how most people get familiar with retirement plans, is making a contribution and getting a tax deduction. But it doesn't always have to be that way. You'll learn about that in just a second. So they contribute to the 401k, they get a tax deduction, they roll the money over into a traditional IRA, no taxes or penalties to move the money. They're now in a self-directed traditional IRA. Then at that point, Kevin and Cynthia say, you know what? We don't want to have to pay taxes on the seed, or I'm sorry, we don't want to have to pay taxes on the much larger crop. So there's this analogy that's used in the industry is you either pay taxes on the seed or you pay taxes on the crop. So for Kevin and Cynthia, they said, we don't want to have to pay taxes on the crop because we know that we're going to make a very meaningful profit on our investments. And so they decided to get the taxes out of the way on the seed by doing what's called a Roth conversion. So you're going to write that down, Roth conversion. Now, this is not for everyone, but it was certainly for Kevin and Cynthia. So they took the $100,000 that was in the traditional IRA and they converted it to their Roth IRAs. At the time of converting that $100,000 to the Roth IRA, they had to pay taxes because they went from tax deferred, tax deductible to tax free. At that time, they were at a 35% tax rate. So 35% of $100,000 is $35,000. So they paid $35,000 in taxes to get the $100,000 into their Roth IRAs. Now, I know some of you are probably saying, well, why in the world would they pay $35,000 in taxes? That's a very large tax liability associated with that movement. Well, you're going to see in just a moment on why they did that. So they got the money converted over to their Roth, and the $35,000 in taxes, they didn't take that from the IRA. They paid for that out of pocket. Why did they do it that way? Because A, they didn't want to have a 10% penalty by taking money out to pay the taxes. See, if you take money out prior to 59.5 from an IRA, you have a 10% penalty and ordinary income taxes. But if you pay the tax for the conversion out of pocket, you don't have to worry about that. Also, when you're buying and selling real estate with your IRA, you're not paying taxes. You're not borrowing from the account. You're not taking a distribution. There's no tax liability. Your IRA is actually buying the property or making the loan or buying the asset. It's just like buying a stock or mutual fund. And so they got the taxes out of the way. They're in their Roth IRA. First deal they do is a buy, fix, and sell on owner financing. So one of the first houses they bought for, it was around $25,000. So they bought a house. It was a fixer upper for $25,000. They put about $20,000 worth of work into the house. So they were in it for about $45K. And then they sold it on owner financing for, it was roughly $97,000. So they got a down payment from the buyer. And this was their path to home ownership program. Sold it on owner financing. The IRA held a note and mortgage. And then in about a year and a half to 2 years, that homeowner was able to refinance, and they at that point recognized their profit. So the profit was delayed about a year and a half to 2 years because they needed some seasoning time, right? They needed time for that homeowner to restore their credit and be able to qualify and go out and do a refinance and pay off the mortgage. And so at that time, they had their profit flow back into their Roth IRAs. And then they went out and they did a second transaction, then a third transaction, and a fourth. So their strategy is buying houses at a significant discount through the renovations, forcing a significant amount of appreciation, and then through either a lease option to purchase or an owner finance type arrangement, eventually they're harvesting their profit, all of which is tax-free in their Roth IRA, and then redeploying that capital for future investments. So it's like a snowball rolling down the hill. They didn't get to $1 million plus in properties and $130,000 in tax-free cash flow in the first 3.5 to 5 years. It was at about year 6 to year 7 when when that snowball had enough velocity where the income really started to become more profound. And so this is not a overnight get rich very quick type situation. What we're talking about is creating a plan now so that 10, 15, 20 years from now, you can look back and you can recognize the capability of getting to your retirement goals in the shortest period of time possible through compounding interest in the absence of taxation. Couple things to take away here, and these are important for those of you that are brand new and writing this information down. When Kevin and Cynthia buy properties, their IRA pays cash for the property. Their IRA pays for the fix up and repairs. The IRA receives all of the income, and all of that income is tax-free in their Roth IRAs. So there's no short-term capital gains tax. There's no long-term capital gains tax. There's no ordinary income taxes on the rental income. Now, I know some folks in the self-directed IRA space, they'll make comments such as, well, it doesn't make sense to own rental properties in your Roth IRA because you lose depreciation. I own rental properties in my self-directed IRA. I've been doing this for 15 years. I have 17,000 clients right now that own rental properties in their self-directed IRAs. We've had over 100,000 clients over the last 40 years that have owned rental properties in their self-directed IRA. So when I have somebody that says, well, John, it's stupid to buy real estate, own rental properties in a self-directed IRA because you own depreciation. what my response is, so you're telling me that we've had over 100,000 investors, and these are very, very smart investors that are incompetent. You're also telling me that I'm incompetent. And so, as you can tell, I take great offense to individuals that make the statement that owning rental properties in a Roth IRA doesn't make sense because you lose depreciation. Keep in mind, and the reason why I say that so passionately is because there's going to be a lot of naysayers out there. There's going to be people that are going to tell you never own rental properties in a self-directed IRA. You want to be careful with that. Now, there are circumstances where you might look at a rental property and it might make a lot more sense to own that with your non-IRA investment capital. All right. So let me be clear and not say that every rental you should buy with a self-directed IRA. That absolutely doesn't make sense. You're going to find there are rental properties that are very good for your IRA, and there are rental properties that are much better for your non-IRA portfolio. So you just want to look at each transaction and determine, is this good for my IRA or is this good for my non-IRA? That's the appropriate balance, and it's important to talk about balance when we talk about using our self-directed IRAs to invest in real estate. And it goes beyond rental properties. We'll talk about private lending. We'll talk about real estate joint ventures in just a moment here. So Kevin and Cynthia, they now have 14 cash flowing properties, and they have $130,000 in tax-free cash flow on an annual basis. There's no long-term capital gains tax, no depreciation recapture, which let me pause there for a moment. As I mentioned, depreciation recapture. Keep in mind that when you own rental properties outside of an IRA, and you sell the property, you have long-term capital gains tax, if you have a capital gain, and your depreciation that you're able to write off to offset your income over all those years, that accumulated depreciation gets what is called recaptured. So it adjusts your basis down further, which then makes your capital gain, assuming you have a recognized gain, appreciation of the property, that's going to expand that amount. And the tax rate of long-term gains versus the recaptured depreciation is different. So this is where you want to talk to your CPA about that your particular situation. That's not a bad thing. If you're making profit long-term on a rental property, that means you're making profit. It just means you're going to have to pay some tax. But in a self-directed Roth IRA, particularly, now the same goes for a traditional IRA. It's just a traditional is tax deferred. But with a Roth IRA in particular, you have no taxes on the capital gains. There's no recapture depreciation. And when you start distributing money from the Roth IRA after 59.5, there's 0% tax. So this leads me to the next point that I want to make sure everybody writes down. Roth IRAs, when you distribute money after the age of 59.5, so write down 59.5. When you distribute money from a Roth IRA after 59.5, 0% tax. There's also what's called a 5-year seasoning rule. The 5-year seasoning rule says that you have to have had the Roth IRA for 5 years before you can start taking tax and penalty-free withdrawals. So the key is, if you don't have a Roth IRA now and you're 55 or older, you might want to consider opening a Roth IRA prior to April 15th, making a contribution for 2021. So that way your seasoning starts January of 2021 instead of January of 2022. Yes, you can still contribute. You have to do it before April 15th, but you still have the option to contribute to an IRA for 2021. All right, so remember 59.5 in that 5-year seasoning period. The 5-year seasoning period doesn't have to do with traditional IRAs, just Roth IRAs. So now in Kevin and Cynthia's case, they're over the age of 59.5. So conceivably, they got $130,000 coming in every single year. That's their tax-free cash flow, 0% tax on that income. If they wanted to, they could distribute that $130,000 and they would pay 0% tax. It would never hit their 1040 as ordinary income. Now, when I asked Kevin and Cynthia, what do you plan on doing with the money in the Roth IRA? What are you doing now with the money in the Roth IRA? I assume that they were taking withdrawals because it's tax-free income, right? What's better than tax-free income? I don't know. And I shouldn't say I was surprised, but I was certainly intrigued by their response, which is, John, we don't plan on taking any money from the Roth IRA at all. Our goal is to leave these Roth IRAs to our children. And if our children have children, we'll leave it to our grandchildren. Folks, this is really important to remember and take away from today's program. Roth IRAs are not only great retirement savings vehicles to get to your retirement goals in a shorter period of time, leveraging compounding interest in the absence of taxation. There are also incredible estate planning, and as I like to call, legacy planning tools. Roth IRAs in general, avoid probate. So in Kevin and Cynthia's case, let's say their children have children. They leave their Roth IRAs to their grandchildren. And let's say their grandchildren inherit these Roth IRAs when they're in their 30s. The grandchildren are going to pay 0% tax. They inherit these Roth IRAs. They can use the Roth IRAs and continue to invest in real estate with the Roth IRAs for 10 years. Write that down. An inherited Roth IRA or an inherited IRA in general, when it's inherited, that beneficiary or beneficiaries have 10 years. They can continue to grow it. They don't have to take any money out unless they want to. They can continue to grow it. And then at 10 years, they have to take all the cash and assets out. Now, remember, a Roth IRA is tax-free, so no taxes to the heirs. So in other words, Kevin and Cynthia paid the taxes in their lifetime, so their heirs didn't have to pay the taxes. Now, I said 10 years. There was a piece of legislation called the Secure Act. It was passed in December of 2019. It went into effect January of 2020. Under the Secure Act, some rules were changed with respect to inherited IRAs. The major rule is exactly what I just said. Under the old rules, you could take money out of an inherited IRA over your lifetime. You had to take some money out every year. They're called required minimum distributions, but you could take it out over your lifetime. Those rules changed in 2020. Under the Secure Act, you have 10 years to distribute the entire IRA. So a Roth IRA being left to children or grandchildren could be advantageous because the children or grandchildren don't have to worry about any tax liability. And just remember, IRAs avoid probate. Now let's rewind for a moment. And I mentioned before that Kevin and Cynthia paid $35,000 in taxes to get the $100,000 into the Roth IRA. They have $1 million in properties and $130,000 in cash flow coming in every year. Now let's do some quick math here. Let's say that Kevin and Cynthia did not convert from their traditional to their Roth. Let's assume that they kept it as a traditional. Under traditional IRA rules, when you distribute money after the age of 59 and a half, you have ordinary income taxes on whatever amount you distribute. If you take money out prior to 59 and a half, as we said before, you have a 10% penalty and ordinary income taxes. So you don't want to do that. Remember, when you're buying real estate, when you're making loans, when you're doing wholesaling, options, whatever it is that you're doing, as long as you're doing things properly, your IRA is not exposed to any taxes or penalties. It's an investment, just like buying stocks and mutual funds. So Kevin and Cynthia paid the $35,000 in taxes. There are $130,000 coming in every single year. Let's again go back to what if they kept this in a traditional IRA? If they kept it in a traditional IRA, let's say that over 10 years, every year, let's just use the example of 100,000. Let's say they take $100,000 out of their traditional IRA every single year for 10 years in their retirement years. And let's use a tax rate of 20%. An effective tax rate of 20%. So 20% of $100,000 is $20,000. Over 10 years is $200,000. So using that hypothetical example, the math breaks down to, would they rather pay taxes on the seed, which was only $35,000, or pay taxes on the crop, which as you can see here over 10 years is $200,000. And that number is going to be greater because we have to factor in all of the other assets and the other cash that they have in there that they eventually are going to maybe want to distribute themselves or leave it to their children or grandchildren. And then the children or grandchildren have to take on this tax burden. So as far as converting from a traditional IRA to a Roth IRA is concerned, you can convert your entire traditional IRA, or maybe you just want to convert a portion of your traditional IRA. That's entirely up to you. I have an investor here by the name of Alan. He's a buy and hold rental property investor. And over 4 years, he converted money from his traditional to his Roth. Year one, he bought a rental property with his traditional IRA. All in, he was in it for about $100,000. It was a foreclosure, and it rents out for about $1,500 a month. Year two, he converted money from his traditional to his Roth, converted about $75,000 for the purchase and rehab of a rental property, paid taxes on the $75,000, cash flowed the rental. Year three, he converted more money over, bought another rental property. Year four, converted a little bit more money over, bought a fourth rental property. So now he's got one buy and hold rental in his traditional IRA and 3 buy and hold rentals in his Roth IRA. The reason why he converted over 3 years was to spread out his tax burden. So for some of you, you might want to visit with your CPA, your tax accountant, or run the numbers yourself and determine what's going to make the most sense for you in terms of converting from a traditional to a Roth. All of that being said, don't get hung up on the details here. You can still invest with a traditional IRA in real estate, and it could certainly still make a lot of sense for you. I have plenty of investors that invest with their traditional IRA because they had an old 401k or an old 403b or old 457 or thrift savings plan, and they just want to get it out of the traditional financial markets and put it into income producing real estate. So you'll hear of a lot of investors talking about bulletproofing their retirement. And a lot of our investors specifically bulletproof their retirement plans, their self-directed IRAs, hedging against inflation, hedging against stock market volatility, and hedging against potential increasing tax rates in the future, leveraging real estate in the self-directed IRA, hard income producing assets in the self-directed IRA, or potentially private loans, loans secured by real estate, which I'll give you a few of examples of as well here. All right, so that's the Kevin and Cynthia example. And as I mentioned before, compounding interest in the absence of taxation and the IRAs avoiding probate. So the key takeaways from that case study is diversification, tax exempt status, tax simplification. There's no Schedule E or special tax return for the IRA, and the IRA avoids probate. All right, Scott and Kate. So let's now migrate to a fix and flip scenario. In a scenario where 2 investors partnered their IRAs together to do a fix and flip transaction and make a very meaningful profit. So here's what happened. Scott and Kate, 2 equity trust clients. I met them at a real estate investor association in Milwaukee, Wisconsin. And here's the situation. Scott had about a $24,000 Roth IRA, and he opened it in about 2015. And it sat around for about 3.5 years, earning little to nothing, just sitting in a cash account. And Scott's challenge was he was buying properties for $200,000 to $300,000, fix up and repair. And he didn't think he had enough money in the Roth IRA to be able to go out and invest in real estate. And I was able to work with Scott, and I was able to equip him with what's called our master transaction handbook, which I'll share with you in a little bit here. And so Scott learned about how he could put together a real estate joint venture with his self-directed IRA and other investors, or in this case, one individual investor. And on the other side is another investor by the name of Kate. Kate's challenge was that she had a health savings account, a self-directed HSA, and a self-directed Roth IRA. And she had about $200,000 and it was earning little to no interest. And so she was looking for ways to be able to grow that account in a more meaningful way. It was sitting on the sidelines, again, earning little to no interest. Scott had the ability to find investments. He knew how to negotiate transactions. He was able to rehab houses. But his challenge was he didn't have enough money in the IRA again. So Scott and Kate got together and they put together a $224,000 transaction, purchase and rehab. Scott's Roth IRA put in $24,000. Kate's Roth IRA and health savings account put in $200,000. And I'm going to flip over here. They went to our master transaction handbook. So this master transaction handbook details out this real estate joint venture strategy. And Scott and Kate got with their real estate attorney. The real estate attorney was able to use this diagram as a blueprint. And we also have a sample document in here as well. And so I can share with everybody on today's call, if you're interested in this master transaction handbook at the end, I can share with you how you can get a hold of this. So they were able to retrieve these sample documents and the diagram, and they were able to put this transaction together. So the agreement was between Scott and Kate was that Kate's Roth and HSA would receive 30% of the profits, and Scott's Roth IRA would receive 70% of the profits. The profit was about $60,000. Scott's Roth IRA made $42,000 tax-free, and Kate's Roth IRA and HSA made $18,000 tax-free. So Kate's Roth and HSA made about a 9% return, annualized 18%. Scott's Roth IRA grew from $24,000 to over $66,000, all tax-free. Now you're probably asking, wait a second, why did they structure it where Kate's Roth and HSA only got 30% of the profits, but she put $200,000 in the deal? Well, Scott's the one who found the investment. Scott's the one who put this all together, okay? He made an investment with his Roth IRA, $24,000. He had skin in the game. That's really important. These are IRS regulated, if you will, accounts, all right? So we have to make sure the IRA has skin in the game. And that's exactly what Scott did. Another question that oftentimes comes up is, why didn't Kate's Roth and HSA just make a loan to Scott's Roth IRA? Well, what you're going to learn is when IRAs borrow money, your IRA would have to pay a special tax called unrelated business income tax. So in an effort to mitigate this, they structure this as a real estate joint venture. So that's the real estate joint venture concept. Now, some people might be asking the question. I'll flip over to the questions here and see if we have any questions so far. I don't think we do just yet. If you do have questions, feel free to ask them. Usually the question comes up, John, well, wait a second. I heard that if I use my IRA in partnership with another individual or entity, that all income and all expenses has to flow proportionally. That is only if you partner with what's called a disqualified person. That would be yourself, your spouse, your children, your parents. And so if you partner with immediate family members, if you will, then yes, you have to make sure everything is done proportionally. But the key component here with Scott and Kate is that they were not disqualified persons to one another. They were two investors that met each other at a local real estate investor association. They met an attorney at that same real estate investor association. They met me, and I was able to introduce them to our master transaction handbook. So they actually had the blueprint and the checklist to walk through the transaction effectively. All right, so that's Scott and Kate. Now, let me pivot for a moment. We've been talking a lot about traditional Roth, tax-free, tax-deferred. Just so you can wrap your brain around what all of this means, let me give you just a quick example: compounding interest in the absence of taxation. So if I start with $6,000 going into an account every single year for 25 years, and I make a return of 12% per year, and I pay taxes at 30% in each one of those years, and I have a tax rate of 20% when I take all the money out, if I run these numbers in a taxable environment, I'll have $601,000 saved. In a traditional IRA environment, which remember, that's tax deferred. When we put money in, we get a deduction. It grows tax deferred. When we take money out, we got to pay taxes. We'll have close to $900,000 left. So taxable versus tax deferred, we're nearly $300,000 in tax savings. This is the advantage of a traditional IRA over a taxable environment. We then have a Roth IRA, which you'll see here if we run these same numbers, we have 1.117 million. So we're over $200,000 in savings, traditional compared to Roth, and Roth compared to taxable, we're over $500,000 in savings. Now, I know we could split hairs here and we could say, well, what if we look at short-term gains tax rate versus ordinary income tax rate? What if we factor in the deductions on the traditional IRA and putting that money into other income-producing investments? We could certainly split a lot of hairs on this. All I'm doing in this simple slide is sharing with you the difference between a traditional IRA and a Roth IRA. Just remember, you either pay taxes on the seed or you pay taxes on the crop. Now, I'm a little ways in here. I always need to make sure at some point in the program that I mentioned that Equity Trust is a directed custodian. We don't provide tax, legal, or financial advice, and we're here to provide education and information. We do provide a lot of education, a lot of information. We are a custodian. We are regulated by the South Dakota Division of Banking. So we can't give tax, legal, or financial advice, but we can give a lot of education, a lot of information. We have YouTube videos, we have books, we do presentations all across the country. Again, I've been teaching this strategy since 2007-ish. I've been in real estate for close to 20 years. So you'll find there's a lot of education out there. What I will caution folks on is there's a lot of education, but it's sort of fragmented, and there's not really a one-stop shop, if you will, I have found, for authoritative education on self-directed IRAs. And there's also a lot of misleading information out there. So I find a lot of websites and I find a lot of content out there that, quite frankly, is just not accurate, or it's very misleading. It's very hypey, if you will. And so what we've done is we've actually created what's called our self-directed IRA master course. And at the very end here, I will share with you a little bit about that. And if you're interested in pursuing becoming part of our Master Academy and getting a hold of this all digital e-learning experience, I'll make sure that I spend a little bit of time talking about how you can take advantage of that. All right, pivoting to solo 401ks. I know some people had questions in preparation for today's program on self-directed solo 401ks. A self-directed solo 401k is just an account type. Very similar to an IRA. You can buy and sell real estate with a solo 401k. The difference is a solo 401k is for business owners who don't have any employees and have eligible earned income. What you'll learn is to open a solo 401k, you have to have income that you're paying Medicare and Social Security tax on. So here's the way a solo 401k works. With a solo 401k, you have both a tax deferred, call it a traditional bucket, and then you also have a Roth bucket. So with a solo 401k, you can contribute as an employee up to $20,500 when you're under the age of 50. And when you're 50 and over, you can contribute up to $27,000. With an IRA, individual retirement account, you can contribute up to $6,000 when you're under 50, up to $7,000 when you're 50 and over. So as you can see immediately with the solo 401k, if you have enough income as a business owner, you can make substantially higher contributions on an annual basis. But it doesn't stop there. You also have what's called an employer deferral. So with the employer deferral, you are limited to 25% of your W-2 income or 20% of your self-employment income. But if you're making enough money, the combined contribution between you as an employee and an employer can be up to $61,000 when you're under 50, up to $67,500 when you're 50 and over. So there's a lot to unpack with the self-directed solo 401k, but to make it very simple in today's presentation, let me give you an example. Let's say we have an investor that's making $100,000 and let's say $150,000 in gross Schedule C income. So investors making $150,000 in gross Schedule C income, and they are reporting $100,000 of that $150,000 as self-employment income. And they pay Medicare and Social Security tax on $100,000. That's the price to pay to get in the game, folks. You have to have earned income that you're paying Medicare and Social Security tax on. Newsflash for everyone, if you don't have any earned income, you are not going to qualify to even open a self-directed solo 401k. And please forgive me for being very blunt about this, but the reason why I am is because there are companies out there that sell self-directed solo 401ks that will allow you to open the self-directed solo 401k, even though all of your income is passive income and none of it's reported as active earned income. And the reason why that's wrong is because the IRS says so. If you go to the IRS website, it states very clearly that if you aren't making recurring and substantial contributions, and to make recurring and substantial contributions, you have to have earned income, then your plan is going to be considered terminated. You can't even open up a self-directed solo 401k. So be very, very careful if you're studying the self-directed IRA business and you want to get started. you want to make sure you open up the right account type. Far too often do I find investors make a mistake and open up a solo 401k and they're not eligible to do so. So back to this example. John makes $150,000, passes $100,000 through to a Schedule SE self-employment, pays taxes. John is 50 years old, so John could put $27,000 right into the Roth bucket after tax. So he's getting 4 times more into a Roth bucket compared to a Roth IRA. Then from there, he does 20% of his $100,000 into the employer deferral, which has to go into the tax deductible bucket. But then from there, he can do what's called an in-plan conversion and convert that entire $20,000 into the Roth bucket, netting him a total of $47,000 tax-free. So now he's got $47,000 tax-free in the Roth bucket. Now, again, I know there's a lot to unpack there with the solo 401k. I have an extended training all on self-directed solo 401ks, the pros, the cons, how do you analyze which account type is going to make the most sense for me. We have an extended training all on that I can help you with. Just wanted to give you the high level overview in this short program that we have with you today. All right, 3 methods to finance real estate transactions. You're going to want to write these down. The 3 methods to finance real estate transactions. Number 1, cash buyer. So your IRA buys a property as a cash buyer. Your IRA pays for fix-up and repairs. Your IRA will then receive all profits. The second is partnering. You can partner with yourself. You could partner with your non-IRA funds. You could partner with your spouse. You could partner with children. You could partner with other investors. I gave you an example already of Scott and Kate partnering their IRAs together. And then last but not least, your IRA can be used for a down payment. In other words, your IRA can borrow money, but it has to be in the form of a non-recourse loan. Has to be in the form of a non-recourse loan. Non-recourse loan means in the event of a default, the only recourse is against the subject property. So the lender cannot come after you through a deficiency judgment. They can only go after the property. This is called non-recourse. Why? Under the provisions of Internal Revenue Code 4975, you can't sign a personal guarantee. And most conventional lenders are going to demand when you borrow money that you sign a personal guarantee. You can't do that with an IRA. Now, fortunately, I do have a list of non-recourse lenders, nation lenders that loan to IRAs, and we have an extended training all on non-recourse loans. So if you're someone that's looking to buy real estate with leverage, we can share with you more details on how that works. You do have to know that when your IRA borrows money, that's one of the few instances where your IRA is going to be taxed. It's called unrelated business income tax. And it's a special tax on IRAs when engaging in debt finance real estate transactions. So for example, if you bought a property for $100,000 and borrowed $50,000, you'd be at about 50% debt. So what's going to happen is 50% of all of your net operating income, or I should just say net income in general, including depreciation. So you have to factor in expenses, including depreciation, but you would have to pay taxes on 50% of your net income. And so unrelated business income tax is a factor in your return on investment, and you're going to need to analyze that and determine if it makes sense for you. Some investors are very fearful of this. They don't want their IRA to borrow money. They don't want to worry about UBIT tax. What I'll tell you is if you have enough cash in your IRA or you have cash plus a partner, you don't have to worry about that. But if you're somebody that doesn't have those options, then it might make sense for you, for your IRA to actually go out and buy real estate with debt financing. There are plenty of investors that I work with that utilize that strategy and they find it very advantageous. All right, so that's the 3 methods to finance real estate transactions with your self-directed IRA. Let me give you a couple examples. This is Gary from Ohio. He bought this property. It was a foreclosure right outside of Cleveland, Ohio. $68,000 on the purchase, $20,000 in improvements. IRA paid cash for the deal. IRA paid cash for the rehab at $20,000, in it for $88,000. There are 2 units in this property, $950 on unit A, $900 on unit B. Net operating income is $1,400. There's no mortgage, so net operating income is $1,400. The appraised value is $140,000. So if he sells the property, there's no long-term capital gains tax. Gary just turned 59 and a half, and hopefully this answers the question that came in before. Gary is now 59 and a half, so he can take a distribution every month if he wants to of $1,400 and pay 0% tax. So I find a lot of investors, they're growing their Roth IRAs, owning income producing properties, so they can get to a point where all of their cash flow is tax-free. And now they can start living off of that tax-free cash flow. Deal number 2, Gary bought this property. It was a fix and flip transaction for $41,500, put $30,000 worth of work into it. But instead of his IRA buying it in cash, he actually partnered his IRA at 75% and then his LLC at 25%. So let me show you what the titling looks like. The titling you can see down here in the bottom: equity trust company, custodian, FBO, Gary's IRA, undivided interest 75%, and his LLC undivided interest 25%. So it was a 75-25% split. His IRA was on title along with his LLC as tenants and common owners. So you're going to learn that you don't have to form an LLC, trust, or other entity. Your IRA can take title to properties directly. And that's the way most of our clients do this. There are some circumstances that warrant an LLC structure or maybe a land trust structure. In our master transaction handbook, we actually have the diagrams and the blueprints and the checklist for all of that if that's something you decide to do in the future. But keeping things very simple, which is the way a lot of our clients like to do it, and keep it very low cost, his IRA is buying it directly in the name of the IRA. So what's a key point to take away here, everyone, is the IRA bought it at the time of closing 75-25. So purchase 41.5, 75% of the closing amount came from the Roth, 25% came from Gary's LLC. The expenses of $30,000 also had to be split up 75-25. So this is a little different than the Scott and Kate example. In the Scott and Kate example, Scott and Kate were not related to one another. They were disinterested third parties, non-disqualified persons. So they could split up the percentages any way that they can agree to. In this case, Gary is a disqualified person to his LLC. For obvious reasons, the IRS is not going to allow Gary to have 25% of this funded by his LLC, but then his IRA reap tax-free profits at 100%. So Gary has to make sure that the profits are split 75-25. So when it was all said and done, the property was sold for $116,000, $10,000 in closing costs, $26,000 tax-free went back into the Roth, and $8,600 went back into his LLC. Now, these numbers might not make sense for you in your market because the purchase price and rehab might be a lot more costly or expensive in your marketplace. That's okay. You can kind of plug and play these numbers in any market, regardless of what type of property you're buying. All right. But you do, of course, have to start with some money in your IRA. And if you're in a much higher value market doing fix and flip transactions, then, I can argue, and one could argue, that you might need a little bit more working capital. In that case, it might make more sense to partner up with another investor, like in Scott and Kate's example. So if you're somebody that's saying, well, I buy houses for 300, 350, and we got to put 100,000, the average transaction is $500,000, John. Well, in that instance, you're likely going to want to look at a joint venture with a third party, a non-disqualified person, as a start, build up your capital, then you can move on to transactions like this or buy and hold transactions. This is the titling for an investment. Just so that you understand, when your IRA is executing on a purchase contract, you have to make sure that's in the name of the IRA. And another partnership example to share with you briefly, this is a rental property that I own between my Roth, my traditional, and my LLC. So I bought this property for $63,000 in March of 2020. It's a double right outside of Cleveland, Ohio. $750 on unit A, $750 on unit B for a gross income of $1,500 a month. Net operating income is around $1,200 to $1,300 on a monthly basis. So I have my Roth at 55, my traditional at 35, and then my non-IRA capital at 10%. So I just have to make sure that all my profits and all my expenses flow 55, 35, and 10%. So just wanted to share that as another example of partnering multiple individuals that are disqualified persons. So we have partnering with disqualified persons and partnering with non-disqualified persons. How do we actually execute on real estate investments with our IRA? We do this through the Equity Trust My Equity Investment Portal. So if you're already an Equity Trust client and you're not familiar with this portal, I'd encourage you to become familiar with this portal. If you're not an Equity Trust client, that's okay. We can help you establish and fund an account, of course. As an Equity Trust client, we give you this digital processing portal that enables you to process your real estate transactions. So gone are the days of having to fax or scan an email documents into a firm. You're going to find that there's some folks out there that say, well, it's really difficult to invest with a self-directed IRA because you have to have a custodian and there's administrative work and it could be burdensome. But what you're going to find is technology and the advancements of technology over the last 5 years have made it incredibly easy for our investors to execute on real estate transactions. We actually have what's called a real estate and note purchasing portal. So you can process your real estate transactions or your private loans all digitally, all online. We have a bill pay system. So when you have expenses that come up, you can have checks mailed out to wherever they need to be mailed out to. We can mail checks to you. We have a tenant payment center and a borrower payment center. So instead of your tenants or your borrowers having to mail checks, they can just access a link, go into a portal, put in their bank information, and then a direct deposit is sent into the account. We also have a prepaid card. Think of it like a debit card. So when you have expenses that come up at Home Depot, for example, let me recognize one of the big box stores that's affiliated with National RIA, Home Depot. You go to Home Depot, let's say you buy a refrigerator, you can use your prepaid card, buy the refrigerator gets delivered, they take out the old one, right, you're done. Your hands off and you're managing your self-directed IRA rental property, doing the desk work. So we've created these features and functionality to make it really easy for our clients. You upload all of your documents. We have generators to generate different transactions that are occurring, video tutorials and training. We even allow you to invest in mutual funds. So if you still want some exposure to the traditional financial markets, you have the capability of doing that, whether mutual funds or even linking your account to an ETC brokerage account for individual stock purchases. So although our clients are very keen on investing in alternative assets like real estate, you actually have the ability to go beyond just real estate. You can manage everything all under one umbrella, managing a portfolio of both traditional financial market related investments, as well as your real estate alternative investments. And then all the record keeping and bookkeeping. So a lot of investors are fearful of making a mistake or not keeping good records because these are tax privileged IRAs. So if you're running things properly, all the bookkeeping and all the record keeping is done self-contained right in that self-directed IRA. Okay, let me stop sharing my screen for a moment and just pan. It looks like there may have been a couple questions here. Must you take money out of your Roth IRA after age 59? You don't need to take money out of your account after the age of 59. That is the only time you're required to start taking money out is at 72 years old. Okay. And then quickly, let me mention private lending. So one of the ways that my wife and I have kept the velocity of our money moving. See, what my wife and I are very afraid of right now is inflation, right? We understand that if our dollar is sitting in a non-interest bearing account or a minimal interest bearing account, we're losing money right now. Inflation's at 8%. And so one of the ways that we keep our uninvested cash going for us, moving for us, is by making loans to real estate investors. And so one of the real estate investors that I met at my local RIA, he needed financing for this project. I made a $50,000 loan with my self-directed Roth and traditional. I partnered the two accounts together. I charged 14% interest, 8% for the first 6 months. The house was bought and sold in 4 months. My payoff was $54,000. My profit was $4,000. My taxes were $0. See, this is key. When you're making loans, if you're a private lender and you make loans, the interest income is subject to your ordinary income tax rate. Now, for me, my wife and I have W-2 jobs. We're part-time real estate investors. So our income, we're at a 30% effective tax rate. So 30 cents on every dollar of interest income is going to be subject to taxes. But we do these private loans with our self-directed IRAs, so we pay 0% tax. Again, going back to compounding interest in the absence of taxation. That's why we're so passionate about this, because it's helping us get to our retirement goals and our financial goals in a shorter period of time. And the great thing about it as well is my wife and I have the opportunity to also teach other investors, mentor other investors, and share all of these compounding interest in the absence of taxation strategies. and give people the blueprints and the checklists and the video tutorials and everything else that they need to be successful. So here's what I have for everybody in closing, and then I'll take any questions that we have for the remaining amount of time. The Self-Directed IRA Master Course for Real Estate Investors. So I shared with you before Scott and Kate, and Scott made $42,000 tax-free. Scott used our real estate joint venture diagram here with the sample documents. His attorney was able to draft everything for him. And this is our master transaction handbook. Now, the master transaction handbook goes well beyond just joint ventures, multiple member LLC structures for your IRA, land trusts, private loans, examples of promissory notes and mortgages for your IRA. We have this all in this master transaction handbook. Now, bottom line for Scott, Scott was about to pull the trigger on that deal, and he would have still made $42,000 in profit, but he would have paid taxes on that $42,000 in profit. At his tax rate at that time, he would have paid about $12,000 in taxes. So he saved $12,000 using this master transaction handbook. So let me share with you the nuts and bolts of the Self-Directed IRA Master Course and how you can get access to this and follow up to today's webinar. So with the Self-Directed IRA Master Course for Real Estate Investors, we're going to give you our beginner to advanced virtual classes. So these are video training sessions. It's all e-learning. So this is an e-learning platform. And within the e-learning platform, you have these various modules. And you'll see here just some of the topics. Buy and hold. So if you're somebody that's a buy and hold investor, you're going to attend the buy and hold classes. These are all recorded classes, by the way. So this isn't something you have to attend live. It's something that's recorded. You can listen to it on your own time based on your schedule. Buy and rehab. If you're a buy and rehab investor, we have a virtual class on that. Account types. I mentioned solo 401ks versus IRAs. So we have an entire module all on the various account types and what account types would make the most sense for you. Legacy planning, how to set up your IRA for success in leaving it to your children or grandchildren. Should you name a trust, like a revocable trust? Should you be naming it a spouse? Should be named a spouse and then a revocable trust? How does the Secure Act work? We cover all of that. What I can tell you is one of the biggest mistakes I see with investors using self-directed IRAs is that they fail to name the appropriate beneficiaries to their IRA and structure it in a seamless way for their heirs. For example, I recently came across an investor, unexpectedly passed away, had 4 children listed on his IRA as beneficiaries. He has 10 properties. That means those 4 children, which by the way, don't get along all that well. Those 4 children have to split up each one of those 10 properties, 25, 25, 25, 25 into their separate inherited IRAs. And then they need to cooperate in order to manage these properties. Again, they don't get along that well. Not a good structure for the IRA. In the legacy planning course, we teach you how other investors have structured things in a more seamless way. Debt financing in UBIT, how does that work? How do you do the calculations? We actually whiteboard for you here in the virtual classroom. We whiteboard for you what this looks like and how it works. How to put the pen to paper and calculate what your UBIT exposure might look like. Non-recourse loans. I brought in one of the top non-recourse lenders in the country to do an entire class on IRA non-recourse loans. So that is the beginner to advanced virtual classes. We also have these micro sessions, I call them, our Take 5 video series. So this is broken up into bite-sized chunks for you to consume when you need to consume it. And let me pause for a moment and also mention that this course can be great for you if you're looking to raise capital from private lenders or other investors. You can take this course in the videos, and we actually have a video all on private lending. So you can actually pull up on your laptop in front of a private investor, and you could show them video content that's specific to self-directed IRAs doing private loans. And then you can show them the master transaction handbook. All right, so you have professional material that you can utilize that makes you look professional so that you can make sure that you're putting on the right facade, the right professional physique, so that investors will trust you and understand how a self-directed IRA could potentially work for them as a real estate investor. All right, so the Take 5 video series from joint ventures to Roth conversions. We have it all in there for you. You're going to get the master transaction handbook. That is what I showed you before. So you got sample documents, you have diagrams, you have checklists, you have FAQs, all built in the master transaction handbook. And then we also, it's not just myself and my colleagues teaching these courses, it's also equity trust clients. So I mentioned Kevin and Cynthia at the very beginning. Kevin and Cynthia spent time doing a virtual class all on how they've put together these real estate transactions over the last 10 to 12 years. And so they teach this class so you can learn from them directly. Jan and her daughter, Brittany, they do house flipping in their Roth IRAs. They actually partner their Roth IRAs together. It's a husband and wife and their daughter that partner their Roth IRAs together for fix and flip transactions right outside of St. Louis, Missouri. And so they share how they do this. Chuck and Gina, they buy houses on owner financing. So if you want to learn about how, if maybe you don't have a lot of money in an IRA, like a Roth IRA, and you want to learn how to buy houses on owner financing, Chuck and Gina teach you how to do this with your IRAs. You're going to get some investment processing manuals. So when the rubber meets the road, how do you do this? We give you the checklists and the blueprints. Lots of client case studies. There's no shortage of that. We have transacted with, in terms of real estate, well over 200,000 transactions over the last 40 plus years. So we have thousands of transactions that we can actually peer into, and we can share what these transactions look like with other investors. Rules and guidelines. So we find investors are worried about the ghosts and goblins that are lurking in the shadows. So we give you the reference material so that when you're about to embark on a self-directed real estate transaction, you have the guidelines and the blueprints to invest with confidence. And then account types. So as you're selecting the right account that makes the most sense for you, we have reference guides for you. But let me also mention that we are going to provide to you a single point of contact IRA consultant that after you become a master course member, you're going to receive a phone call after today's program, and they're going to be sort of your sidekick. They're going to help you through answering questions. And then they're also going to help you establish and fund your first self-directed IRA. So the process is this. You take advantage of the master course, you get logged in, you can start learning, you open your self-directed IRA, you continue to learn, and then when you're ready to pull the trigger on an investment, you have all the pieces of the parts in place for you. One of the biggest mistakes I see investors make is they'll fail to open and fund their account in advance, and they'll try to scramble after they get a deal under contract. The problem with that is they've already put the property under contract in their name personally, not their IRA. They don't have money in the IRA for an earnest money deposit, and your IRA has to pay for the earnest money deposit. You personally can't write an earnest money deposit and then try to have your IRA come in after the fact. IRA has got to come in from the very beginning. And if you have an IRA or a 401k elsewhere, that other financial institution isn't going to be willing to just overnight the money to equity trust. So you have to make sure you're very diligent here. You have to make sure that your account is established and funded well in advance, so that way you don't miss out on any transactions. So ultimately, to cut to the chase for everybody on today's program, here's what you need to do. So the self-directed IRA master course for real estate investors, it's $1,985. Today, on today's webinar, it's $997. All right, so what we're going to do is we're going to have this open until this evening. It's $997. And I'm going to post this link in the chat box for everybody in just a moment here. But let me also mention that our goal at Equity Trust is to help investors be successful with their self-directed IRA. That's our number one priority. And there's, of course, the cost to this. And that's why there's a cost to this program. This is a professional e-learning. It's on an e-learning platform. And there's a cost to that. And we have a state-of-the-art virtual classroom here where we conduct all of our sessions professionally. Everything is edited, reviewed, and we go through this with methodical detail to make sure that it's accurate and make sure that it's timely and make sure that it's relevant to your specific needs. And so the reason why we do this is so that you as an investor can grow your IRA and be more successful. Like Scott, who I mentioned at the beginning, he went 3.5 years without ever doing a deal. And we don't want to see that happen. We want investors to grow their IRAs, because if they grow their IRAs, they're going to tell their friends and family members. They're going to grow their IRA and they're going to pay a fee to Equity Trust every year. And we're going to be more successful as well. So we have mutually, if you will, benefiting goals in terms of helping you grow your self-directed IRA. And so that's, I just want to make sure I get out there for everybody, our purpose behind doing this and why we do it and why there's a cost to it. If you are someone that is going to open an account, or if you already have an account, you're going to get the course for $497. How do you do this? All you need to do is purchase the course. If you already have an account, we'll validate your account and we'll refund you $500. If you're someone that wants to open an account, the course is $997. When you open your account, we refund you $500, making the course only $497 for you. So when you see $997, know that this can very soon be only $497 for you. For those of you that already have a self-directed IRA, or for those of you that open and fund a self-directed IRA. Having all that being said, one of the questions I get frequently with this course is with respect to, what if I have a self-directed IRA with another company and I don't feel comfortable moving that to equity trust? That's fine. We totally respect that. This course is offered and designed to be agnostic for investors that have self-directed IRAs elsewhere. So the same strategies can apply. And so you can take advantage of the course. If you eventually want to open an account, that's fine, great. If not, that's okay too. The cost of the course is $997. You're going to find the material certainly will still apply to you. Ultimately, we created this because we know that investors get stalled out. They have money in their IRA, they don't do anything with it. Or there's investors that never get started with a self-directed IRA because they don't feel they have the knowledge or the access to the knowledge. And so the course really starts to put together all those pieces of the puzzle for you. All right, so let me stop there. Let me post the link in the box for everybody. And let's see if I could just take any last minute questions that came in. So let me make sure Alexa, send this to everyone. Okay, so the link is now in the chat box for everyone. So that is the link that you'll want to use to register for the course. So you'll see you're going to go to a page. I can show that to you briefly here. So you're going to go to this page here. You have all the details of what you're going to get. By the way, this is just a one-time charge of $997. There's no upsells. There's no additional bolt-on products or education. And once you open your account, again, you get a refund of $500. All right. So we want to make this really simple for people to get educated on self-directed IRAs. And that's why we do that. So you're going to hit register. You're going into the secure portal, and that's where you're going to purchase the course. All right. So let me stop there. Alexa, feel free to jump in. I know I'm probably going a little bit over time here.
No, you're perfect.
Any questions?
Yeah, we have a couple more minutes for questions. Okay, I see a couple in the Q&A. Let's see. You probably hit this one because it was also in the chat. The farmland within your IRA. Did we hit that one?
Yeah, so you can absolutely buy farmland with your IRA. You just want to be careful that you don't engage in a prohibited transaction. So what I mean by that is your IRA couldn't buy a property and then you farm it. But if your IRA is going to buy a property and then you're going to lease it out to a farmer, we have hundreds of investors that do that. And I think that could be a very creative way to grow your IRA in a meaningful way. You can buy vacant land. I have thousands of investors right now that are buying vacant land. And why do you think people are buying vacant land right now with their self-directed IRAs? A hedge against inflation, right? Simply put, people are buying land as a hedge against inflation. And we're seeing that in pretty high volumes with self-directed IRAs right now. All right, let's see what else. I can read through these as well, like Alexa, but feel free to shout one out if you see one that.
Perfect. So let's see, what are some differences between owning rentals with a self-directed and other portfolios?
The difference between owning, So the primary difference in owning a rental property in a self-directed IRA compared to owning a rental property outside of your self-directed IRA is your IRA is tax-free or tax deferred if it's a traditional. You don't get depreciation, but like we talked about at the beginning, your IRA is tax exempt. So you're not losing depreciation. You don't have income that's taxable, so there's nothing to write off. And it's important to note that when your IRA owns rental properties, you want to stay away from the physical hands-on work. The rule of thumb that we use is you can do the desk work, but you shouldn't be doing the physical sweat equity. Now, property management, many would argue, is desk work. So marketing for tenants, if you will, working with tenants on their leases, getting the property filled, getting vacancies filled, that all we could consider to be desk work. So when your IRA owns rentals, you want to stick to the desk work and hire others to be doing the sweat equity for you. And if you think about it, the IRA is a tax exempt account. So what you might be paying for more in the form of expenses, you should be getting back in the form of some tax-free benefits. And really for our investors, they're owning rentals in their IRA because they feel they can make a better return and a more stable return compared to the traditional financial markets. So then we go into the diversification play. It's primarily a diversification play. But I can give you some examples. I have a rental that I'm looking at right now. It's 120. It'll rent for roughly $1,300 a month gross. It's not going to be a rental that my wife and I are going to buy with our IRA. It doesn't make sense for us. But the rental that I shared with you before, 63 grand, that's a great rental for our IRAs. It makes a cash on cash of 17%. If I compare that to if we did it non-IRA, we'd actually make a 23% return. So yeah, we'd be making a higher return outside of our IRA, but what we're not factoring in is the taxes we'll eventually pay. If we factor in the taxes we'll eventually pay, we're likely going to be a much lower return. So we're okay with a 17% return in our IRA. Why? Because it's doing better than what the market would be doing. So we're comfortable with that. And oh, by the way, I haven't even factored in appreciation. So if we sell the property, what's our profit going to be? And so you really want to look at every real estate transaction on a case-by-case, in a case-by-case scenario, and don't fall victim to the YouTube videos and the other hype out there that I see that say, never buy property with a self-directed IRA. You know what? Unfortunately, I find a lot of the people that are making comments like that, they have a bias towards you not owning real estate in an IRA. That might just be because they've never had an IRA themselves and they don't understand it. Or it might be because they make money off of you buying rental properties without your self-directed IRA. So you just want to make sure you get the facts straight. And I'm always very clear with people in saying, I'm not telling people to go out and buy every rental property going forward with their IRA. Again, case-by-case basis, you want to look at the numbers and make a decision on what makes the most sense for you.
Definitely, definitely. I have another question. Guys, go ahead and put your last questions in the Q&A if you want those answered. Here we have, can you switch custodians if you'd like, and how?
Yeah, so if you have a current IRA custodian and you want to move over to Equity Trust, you could absolutely do that. If you have properties and notes, you would deed those properties or assign those notes over to the Equity Trust IRA. My teams are trained and equipped to help you with that. You're likely going to have to engage a real estate attorney for the transfer of title and things of that nature, but it can absolutely be done. Or if you're somebody that's in an all cash position with a current custodian, that's a perfect opportunity to move from custodian A to custodian B. We're actually seeing a lot of that right now. And I don't want to get into the good, the bad, the ugly of the self-directed IRA industry right now. But what I will tell you is there are some firms out there where there are customers that I'm seeing are leaving in droves. They're moving their IRAs out to other custodians. And there's a number of reasons for that. You actually want to be very careful when you're selecting an IRA custodian. There are some organizations that are bigger than others. We do tend to find that some of the smaller organizations from a stability perspective have more challenges and could have a higher propensity for a takeover or an acquisition. And it can be a little bit troublesome to go through where your IRA is parked with a custodian and they're acquired by another custodian. So, that by no means, let me be careful, and out of respect for BPM RIA, I don't want to overly endorse equity trust here. Yes, I'm biased. I work for equity trust. I'd love you to come open an account for us. But what I'll say to the entire group, out of everybody's respect, is if you're selecting a custodian or you have a custodian now and you're not really sure, just make sure that you do a lot of due diligence on the company you're doing business with. How long they've been in business? Are they regulated by a state regulator or a federal regulator? That's another important one, because not all are. What controls do they have in place? How do they monitor and manage the cash that's in your IRA? How do you get access to the cash in your IRA? How many employees do they have? How many years of business have they been in? Ask all of those questions so that you can get comfortable with that financial institution, because after all, it's your hard-earned retirement dollars. I know I take it very, very seriously, and I want to make sure I communicate that on today's call.
Absolutely, everyone. Wow, thank you so much, John. I just appreciate that, just, coming from a business professional perspective. That was really great. We love to hear that kind of stuff on these webinars. We want to hear it. We want to hear the truth. We want to hear how it is. We want to hear everything that you just said is exactly what we needed to hear. So thank you. I do want to let everybody know how to get in touch with you, or how to get any questions answered about this link that we just put in the chat for everybody to access the course. If they have any questions about that, do you mind just sending me an email or putting it in the chat for everybody? Perfect. Amazing.
Yep,
so
yeah,
I'll include both John's email and this link in the thank you email to all of you who attended the webinar today. So look out for an email from me. And then John will be here to support. John, do you have any last comments, anything? We're so grateful that you were here today, and that those last comments, just amazing. Like, that's what we love here at BPM. We love the honesty, the truth, and we just want to hear what we need to know, and that's it.
Yeah, absolutely. Well, I appreciate it, Alexa. Again, the comments I made in the introduction, I made sincerely in terms of BPM RIA, and I just really appreciate what you guys do and having me on today. And I did post my email in the chat box for anybody that needs to email me. And if you're going in to purchase the course and you're already a client, if you want to send me an email, I'll verify and I can give you a discount code so that you'll get it for $497. So you don't have to pay the $997 and then have us refund you. I just need to verify that you are a client. So if you're not comfortable with paying the full $997 between now and later tonight, just send me an email right now and I'll verify you. I'll reply back with the appropriate coupon so that you can take advantage of that.
Absolutely. Thank you so much, John. $497 if you already have an account, which our members have full access to equity trust through the member flow portal. So if you have any questions about any of that, being a member, interested in equity trust, you want to talk to Anish about his experience with it, reach out to the office, reach out to myself. We'll talk about it. And I hope to see you all at the next one. The next webinar is next Tuesday. And look out for the thank you email from me. I will include both John's email as well as the special link he provided us today. So thank you so much, everybody. Thanks for being here. Thank you, John, so much. I know you and Anish got to know each other pretty well at the National RIA Cruise, I think.
2 years, yeah.
Anish
a lot of fun.
Loves that stuff. He loves the socializing, but also he learned so much from you guys on those cruises. So hopefully I'll be on the next one because I have a lot learning to do over here too. So until next time, thank you so much, John. I'm sure we'll be in touch. And thank you, everybody. I hope you have a great rest of your day. Thanks for being here.
Thanks. Bye-bye, everybody.
Bye-bye.